Welcome to the deep dive. Today we're getting into something really fundamental, understanding your individual income taxes.
Yeah, it's that time of year for many people.
Exactly. So we've gathered info to break down how taxable income gets calculated, who actually needs to file those crucial deadlines, and importantly, how your filing status affects things.
Right. The idea is to make it all feel a bit less like, we want to make these essential bits clear.
Our goal is definitely clarity and hopefully a bit more confidence for you navigating this.
So we'll basically follow the money, right, from when you earn it, all the way to that final taxable income figure.
And look at the key choices, like
Yeah.
that filing status decision.
Precisely.
Okay, so let's start with the basic formula. Gross income is the top line.
Mm-hmm. That's pretty much everything coming in wages, interest, dividends,
State tax refunds, maybe some business income.
all that jazz. Then come the adjustments, the above-the-line ones.
Right. Things like educator expenses, maybe IRA contributions, student loan interest paid.
HSA contributions too, some self-employment costs like health insurance or half the self-employment tax itself.
Subtracting those gives you adjusted gross income, ADI.
And HEI is a really key number, isn't it? It impacts a lot of other calculations down the line.
It really does. Okay, so after AGI, there's a big choice.
Yeah, the fork in the road, standard deduction or itemized deductions.
The standard deduction is just a flat amount based on your filing status, age, blindness. Simple.
Or you itemize if your specific expenses add up to more. Things like medical costs over that 7.5% AGI threshold.
State and local taxes, but capped at $10,000, remember?
Right, that salty cap. Also home mortgage interest, investment interest, charity donations.
Casualty losses in federal disaster areas,
Yeah.
those sorts of things.
So you take either the standard or the itemized, then there's potentially one more deduction.
The QBI deduction, qualified business income.
Exactly. If you qualify for that, it comes off too. And then you finally land on taxable income.
That's the number your tax rate applies to. Phew! Okay, so who actually has to file a return?
Well, generally it depends on your gross income compared to the standard deduction for your status.
Plus any extra standard deduction amounts if you're 65 or older or blind.
Right. If your income hits that threshold, you usually need to file. Unless you're married filing separately, that has different rules sometimes.
And the main deadline we all know is...
April 15th, generally.
But there's a lifeline if you're not ready.
Yes, the automatic 6-month extension. You file Form 4868 by April 15th.
And that pushes your filing deadline to October 15th.
Crucially, though, it's an extension to file, not an extension to pay. Big difference.
So important. Any tax you think you owe is still due April 15th, or penalties and interest start piling up.
Absolutely. Don't mix those up.
Okay, let's talk filing statuses.
Yep.
This really shapes your tax picture. Single is, well, single.
Pretty straightforward. If you're unmarried or legally separated on December 31st, that's you for the whole year.
Then there's married filing jointly.
Right. If you're married at year end, maybe even common law marriage if your state recognizes it.
Or just married and living together, not legally separated or divorced.
Interestingly, if your spouse passed away during the year, you can usually still file jointly for that year.
That's good to know. The flip side is married filing separately.
Yep. You can choose this even if only one of you has income. How you report income depends on your state, though.
Separate property states mean you report your own income, deductions, etc.
But community property states, it's often a 50-50 split of community income. Gets a bit more complex.
Definitely need to know your state rules there. Okay, 2 more statuses, often very helpful ones. Qualifying widow.
This one's specific. It lets you use the joint return tax rates and standard deduction for 2 years after the year your spouse died.
But there are conditions.
Big ones. You can't have remarried, and you must have maintained a home for the entire year as the principal place for a dependent child.
That entire year part is key.
Very key. Now compare that to head of household.
This also offers a larger standard deduction and often better tax brackets than single or married filing separately.
Right. To qualify here, you generally need to be unmarried, though there are exceptions if you live apart from a spouse.
Can't be a qualifying widow or a non-resident alien.
And you need to have paid more than half the cost of keeping up a home for more than half the year.
And that home has to be the main home for a qualifying person.
That qualifying person could be a qualifying child, or sometimes a dependent parent or other relative.
Parents don't actually have to live with you, just be your dependent and you maintain their home. But other relatives generally do need to live with you.
And notice the time difference again. Head of household is more than half the year residency for the qualifying person.
Whereas qualifying widow was the entire year for the child. Subtle but important distinctions.
Yeah, and underpinning some of this is who counts as your dependent, right? Yep. A qualifying child or a qualifying relative.
We won't go super deep there, but there are tests like relationship, age, residency for kids.
The CARES mnemonic helps remember the qualifying child tests.
And for relatives, it's more about financial support. The support mnemonic covers those rules. Gross income limits, too.
Exactly. It all ties together.
So when you look at that Form 1040, it really is this structured path from all income
Through adjustments.
down to AGI
And deductions.
to finally get to taxable income. Understanding these steps, and especially your filing status, is foundational.
It really dictates so much, not just if you file, but potentially how much tax you owe.
What's really interesting is seeing how the tax code tries, to account for different life situations with these statuses.
Yeah, each status has its logic, attempting to reflect different household structures and financial responsibilities.
But it's something you wonder, doesn't it? How well do these established categories actually capture the complexity of modern families and living arrangements today?
That's a great point. Are they flexible enough? Do they maybe unintentionally push people towards certain structures? Something to think about.
Definitely. And remember, this is just the start. We haven't even touched the details of credits and deeper deduction rules.
But hopefully this deep dive gives you a much clearer picture of these first crucial stages.
Think about your situation. Which status fits best? Getting that right can make a real difference.
And maybe ponder that question about whether our tax system's view of household keeps pace with reality.
Something to mull over.
Yeah.
That's it for this deep dive.